Hello, everyone, and welcome out to your Maverick Trading Anatomy of a Sideways Stock. When we talk about sideways stocks, we're talking about something a little bit different from consolidations, and we'll kind of define the differences as we go throughout this presentation. As always, we want to just remind you that we're going to go through some live analysis, so make sure that anything that you trade and you analyze and so forth goes through your personal system, your personal approach to the market. So let's jump right in here. When we talk about the anatomy of the market moving sideways, it's a little different than a consolidation. And we want to kind of define the differences between sideways price action or consolidation patterns. And we don't think they're the same thing. In other words, one is kind of mindless, listless trading. One is a preparatory kind of consolidation before a breakout. So we tend to ask ourselves, is this a sideways trending stock or is this a consolidation before a big move? And the price action will look different between the two. When you really define it and you kind of think about the price action, it usually is kind of defined by what was happening prior to the sideways move. This, in our minds, would be a consolidation pattern that's getting prepped and ready for a breakout. Whereas if you saw this type of trading, then you might kind of argue that, well, that's just kind of mindless, choppy behavior, right? And both of these could happen on any different time frame. This could be a weekly chart setting. This could be a daily chart setting. This could be an hourly chart. And the same thing here. But there is a difference in terms of kind of the price action and the behavior of that. The indicators will look different. The moving averages will look different. You know, if you think about moving averages in this situation, and we'll talk more about this as we define it, but you would have moving averages that would be upward sloping in all likelihood. And then maybe as you start to consolidate, the faster moving averages, you know, the 20-day or something might flatten out a little bit and kind of come together. But basically, you would have a trending environment. Whereas the moving averages in this type of price action might look like, you know, kind of like this, and another one, you know, might be coming in here and they're crisscrossing and so forth. It's just all kind of mindless behavior, if you will. So there's a difference in our approach to the markets between a sideways trending stock and something that's actually consolidating. And the price action will define that in many cases, and the trading strategies that one would want to utilize based on the analysis would differ. Because a sideways trending stock, you'd use different strategies than something that's consolidating and looks like it's prepped for a big move. So as we look at this, let's take a look at the S&P 500. And this is almost a current chart. This is from yesterday. So we need to add a nice bullish candlestick here that's happening today. We have a big bullish candle here. But basically, what we're looking at is trying to define, you know, what would be periods of choppiness and indecision versus what would be really a trending environment and something that's strong. And so you can see, based on the moving averages up here, see how we came from a well-defined upward trend. When you're in a well-defined upward trend like this and the moving averages are sloping and they're all in proper form and so forth, you're more likely to see sideways price action that is a consolidation before a breakout. A consolidation pattern maybe before a breakout and so forth. And so we would kind of maybe be a little bit more mindful that those can continue. And this chart doesn't go back far enough, but this market had been moving higher for months and months and months. If you go back, there were plenty of consolidations and then breakouts, consolidations and then breakouts all the way up here. Well, because this is just a kind of a 6-month or so time frame, you can see that most of the behavior here is a reversal of trend. So now we break into a downward trend and we break below these moving averages. But notice how the slope changes, how the 20 starts to dive, how the 50 starts to roll over, how you dive below the 200-day. So here you have a big sideways trading range, but it is kind of, a well established sideways range where it's happening, and these moving averages are kind of sloping downward and allowing the price action to catch up, right? So price action starts to build a little base. I think that's still okay from kind of a bearish standpoint. When we continue to dive, and one thing that could have happened here, it didn't really happen in this case, but let me say this: when these moving averages started to dive, what if the price action, instead of being, a wider range, what if it had been a smaller? What if we had dropped sharply and then it was just a much smaller basing pattern? Would it have created the same dynamic and created the potential for a breakdown? And I think the answer is yes. Just as this broke these levels of support and really fell violently lower, same dynamic could have occurred. Now, where do we find ourselves? And here's my best estimate for how this kind of goes. We're in an upward trend right now. That's pretty clear. Here's a little basing pattern, and see how the 20 has started to slope upward. But now you get into this mix where you have a key swing high, major pivot high, and a key swing low, major pivot low. And to me, this is kind of exactly where you get normally that kind of choppy behavior, the swings that are kind of wild, and we go choppy for a period of time. Why? Because you have the 20 sloping upward, but that's it. The short term, we have a bullish bias, no doubt about that. But the 50, it's flat, and the 200, it's flat, and the moving averages are mixed up. If we were in a bull market, you'd have 20 above 50, above 200, right? That's what a bull market trend is. And in a bear market, you'd have 20 below 50, below 200, and we kind of fell into that. But now we're in a little bit of a mixed market where, the 200's up above, and we're trying to kind of push today, in fact, up into that zone. And maybe we're just going to go skyrocketing here, but I don't think that's the case. I think all these moving averages being bunched together with 2 out of 3 going sideways argues for some mindless, choppy, sideways price action. Not so much bases, not so much consolidations that are poised to have big breakouts, as much as kind of figuring out where we go from here, a period of uncertainty. And so you can kind of see that we've had a nice bounce, but we're still well below this key major pivot high. You could say, well, we had such a violent downturn, yeah, but we're also well above this major pivot low. So there's something for the bears, there's something for the bulls, a little bit of a tug of war. And again, you don't have the well-defined. See how price action was above the moving averages, and the moving averages are intact? That's a bullish trend. See how the moving averages were now sloping downward and the price action was below that, all the way through here? That's a bearish trend. See how the stock is inside of the moving averages and they're all mixed up and they're all in a tight sideways range? That is what we would consider to be sideways trading, likely to be that environment of kind of a sideways, kind of an indecisive period. Does that mean you're going to go perfectly flat? Of course not. There's always going to be some bumps up and down, but I think we're going to be in a little bit of a sideways range for a period of time. Now, it's been my analysis. I think that we resolve that to the downside, but let's, put each step in proper order. We probably have a tug of war here for a little period, and then we revert back to the downside. If it was going to continue to be more bearish and more violent, it would not have been able to get above, for example, the 50 period moving average and sustain above it. Maybe it spikes up for a day or so, but it should have come right back below if we were going to be in a more violent downtrend, and if that was going to kind of stay intact. So sideways range, I think the market's going into that behavior, not really consolidations ready for breakouts, but more mindless behavior. So look at something that's super volatile like a Tesla, and you'll still see periods where there are trending kind of environments, but just a lot of indecision, just a lot of indecisiveness. See how as you look at the price action, that might seem like massive ranges, but actually for Tesla, this is a very, very quiet 6-month period where it hasn't moved that much on a comparative basis. This is a stock that, from a volatility standpoint, can have some blowout moves. And you can see once again, just right now, how all the moving averages are bunched together. If it tries to kind of go up or go down, there's likely to be that pulling effect. And you've seen it for a while now. This is something that it kind of went into. So you had similarities where you were in a bull trend and then you broke into a bear trend and see how they're sloping down. So you could have bet against the stock for a period of time. And then it turned a little more bullish, and you could even maybe bet on it for a period of time and played it bullishly in here for a couple of weeks, couple of months actually. But where I feel like we're at now, see how all the moving averages, kind of more sideways price action bunched together. See how when it tries to go below, it gets pushed back above, tries to go above, gets pushed back below, tries to go below, gets pushed back up. And that's the environment we're in, kind of mindless, sideways, a lot of price action there that's not really going anywhere. Sure, it's moving around, but it's not really making significant highs or significant lows. So questions you would ask yourself about sideways characteristics would be, are there new swing highs, new swing lows in the price action? When you have a nice defined upward trend, then you should be going higher consistently than prior highs and going higher consistently on the lows. See how it's making higher swing highs and higher swing lows consistently? So if you build a sideways pattern, that's more of a consolidation. Or same thing happens in a downtrend. We would call this a nice consolidation and a potential setup, right? But if you have like Tesla, where it's, it kind of goes up and then down and then up and maybe even kind of a false move and then like this and so on, and the moving averages are kind of in here. That is not a consolidation poise for new breakouts, because you're not stair stepping up or down. It's just that kind of choppiness, that behavior that really doesn't lend itself to nice consolidating breakouts. Here we see an example where, I would call this an example of something that started to make new swing lows. You can see how it started to break down, new swing lows. When it bounced up, likely to make lower swing highs. So if you see any little sideways basing patterns and so forth, they're tradable. Makes a new swing low, bounces up, makes a lower swing high. You can trade out of this range, targeting more downside. Then the trend reverses. Notice how we plunged to a new low, but then did not make lower highs. We kind of skyrocketed all the way up here. And so now the consolidations and the concepts and everything can reverse. Did we make a consolidating pattern after a nice little upward push? Absolutely. And I haven't even looked at it, but this stock very well might be breaking out today. We have a consolidation on a reversal where this thing is kind of moving higher. Now, having said that, look at where we're at overall, kind of a mixed picture. So you had a well-defined trend here with some consolidations. I would not be betting on massive upside. This probably goes into, after another leg of upside movement and so forth, I'll bet these moving averages get squeezed tighter. There's going to be, a few weeks, a couple of months. I think it'll have an upward bias for the short term, and then probably get into that, mixed picture. You're in an uptrend short term, but the long-term trend is kind of mixed. There's a good chance we're going to have some choppy behavior there in the future. If we look at moving averages, I've talked about this, where they're kind of sideways and crisscrossing. There's a couple of other indicators that one can use to kind of define sideways price action. The CCI and the ADX are two that people will use often for this. The CCI would trade overall kind of around the zero line. Now, it's a faster moving indicator. The ADX is much slower. And the ADX is kind of useful in that that's its job. Its job is to tell you whether you're in a trend or not. And most traders will kind of use 25 to 20 as kind of a little bit no man's land. They usually say anything below 20 means no trend. So if you get a reading in the ADX that is below 20, there's no trend. I kind of use it 25 and below. Anything above 30 is considered to be a trending environment. So it's just gauging the momentum. And again, there's a little level there that's kind of a no man's land, if you will. But I think anything below 25 is kind of a no trending environment. There's not a lot of momentum behind the asset. So if we look at that together, let me pull up a chart. Here's Tesla. And just notice in the Tesla chart, first of all, the CCI is a faster moving indicator. So it's on the top. And you can see some spikes here. But all of them, kind of a little bit more in this period where we had some downward trend and then we had some upward trend. Notice what's principally been happening the past few months is you're in this tighter range and once again kind of around, spending a lot of time coming back to the zero bound, coming back to that level. I think the better indicator, again, for me on a trending environment, I really like, if you're just saying is something in a trend or not, the ADX is very helpful. It's slower moving and really gives you a good definition. I said anything below 25 would kind of tell me we're not in a strong environment. And it's pretty helpful. I mean, here's Tesla, which normally, if you look at the history of this, that ADX is up there, 30s and 40s and all sorts of things with Tesla. For the last 6 months, it's pretty much been telling you this is not a trending asset. And especially for the past few months, this is not a trending asset. It is in that choppy behavior. So it's a very simple indicator that way. This was created by Wells Wilder, one of the kind of famous indicator creators and so forth. You can read up more about that if you want. But if you just simply define it as sub 25, not a trending environment, anything above 30. Now remember, this has not been above 30 at all. Anything above 30 is said to be more of a trend. It just really helps you to kind of define that and see that we're not in a strong moving environment for something like Tesla, which has just been erratic. And it would be really helpful. I mean, think about if you were ready to get super bearish or something, or super bullish when it had this little period of strength or this little period of weakness. This indicator just kind of helped you to say, you know what, we're not in a trending environment here. We are not in a strong momentum environment. And look at how both of those reversed. And we just stayed overall in that sideways pattern. So as option traders, we know we can make a lot of money from sideways price action, right? We can definitely put on trades to take advantage of that. This ADX indicator can be very useful and very simple for that purpose. And this might be the most helpful aspect of this class, is just incorporate that ADX for simplicity's sake. It's just one more thing that we can kind of say, okay, people want to know, do you think this is in a trend or not? Sometimes it's kind of a judgment call. Well, it's trying to break into a trend. It's trying to move into a trend. It's trying to gain momentum. You can look at the ADX and really kind of get a sense of what its opinion is pretty quickly. If it's down here at 18 and 16 and 17 in Tesla, it's just telling you it's not a high momentum environment at all. You'll often see kind of low or erratic volume behavior with lots of sideways and reversal candlesticks mixed in. So when something is more sideways. Again, not consolidating, but sideways. So let's talk about the pattern once again. Here's a nice consolidation. The volume on this would normally have typical bull behavior, where it's higher volume on the rallies, lighter volume on the pullbacks, higher volume as it goes up, lighter volume on the pullbacks, and this is kind of good behavior. And then as it goes sideways, the volume kind of dies down. So you have big volume as it's kind of, or increasing volume, if you will. It's not always this picture perfect, of course, but that's kind of the concept. And as you get pullbacks, you have lighter volume, and as you get consolidations, the volume tends to kind of die off. That's pretty normal characteristic in volume. When you have behavior that is just kind of choppy and all over the place, like Tesla, you'll see some spikes, but they won't really line up with anything. It'll just be erratic, and there'll be a news event one day and it spikes the volume. But we're really, we're seeing some big spikes in volume, but we're stuck dead in the middle of that range. We're seeing some big spikes in volume from time to time, but we're stuck dead in the middle of that range. It'll just be more erratic. It won't follow any kind of normal behavior of supply and demand. It'll just be, of course, there's going to be spikes in volume on news events, but it's not breaking out of its range. It's just happening within that behavior. You'll also see within that erratic behavior, of course, you'll see a lot of dojis and things. So you'd see dojis in here a lot, and hammers and haramis and so forth, where it fits inside of the prior day's body, and yada yada yada. You'll see a lot of these candlesticks just mixed in all over the place. Now think about it. When we talk about reversal candlesticks, think about what a doji is. A doji shows indecision. It shows that you opened and closed at the same price. You traded up, you traded down, but the open and the close just ended up right here, basically a non-event. Well, that can be really helpful if it follows a nice multi-day rally in a downward trend or something like that. You've been downward trending, you get a bounce up for a couple of days, you get this doji, signals that maybe we're ready to reverse. However, if that doji happens in the middle of all this mess, the doji shows indecision, the messy chart shows indecision. It's just not helpful. It's not anything that you can really hang your hat on for trading. So look at something like, Intel. Look at how mixed picture this has been, where you get all this price action just lumped in here, and we can see candlesticks all over the place. We can see, some big expanded range candles. We can see some haramis in here. We can see some little spinning tops. We can definitely see some doji-like candles, some shooting stars in here. You've got hammers in here. You've got, here's a what do they call it? The gravestone doji, right? Where it kind of had that big fall off, or kind of a shooting star light candle. So you've got some dojis. Look at this doji right in here, just picture perfect. And it's just telling you, you're indecisive, but look at how tight the moving averages are. Look at how lumped together they are. This thing is not trending. It's not sharply moving. Now, the question becomes, well, is it going to break out of this? Well, maybe, but right now it's just this big lump of ugly price action. And then look down at the volume and the erratic volume. Nothing that really signals. Big bullish volume, but that's immediately after a plunge. Big bearish volume, but that's after an attempted spike higher and on a gap down. And what did it do? It just stuck us right back in the middle of the range. So even the increasing volume, they're not happening on big convincing breakouts or anything like that. It's just more of that odd, choppy, sideways behavior. So again, just kind of that environment where it's not a real clear, well-defined stair-stepping approach. Swing highs and swing lows, boy, it's messy as can be. If we were just marking the swing highs and swing lows, they're all over the place, right? So you have little periods where maybe it tried to go up for a period of time, but that's just super messy. And how are you going to trade that? I mean, it's just all over the place, right? Now, will that all change at some point? Sure, it will. And this thing will have its momentum at some point, but it'll have to probably break out of this huge range we've been in. It'll have to turn convincing in the volume characteristics, start to create that stair-stepping approach. You'll see more slope in the moving averages, where these moving averages will start to turn and get in proper form, proper shape, and so on. For a good while now, this has been a great example of just that choppy behavior. I didn't even bother pulling up the ADX. Maybe we'll go look at that. This is Intel as the chart. The ADX is probably going up a little bit lately, but I'll bet you it's pretty much been below 25 this entire time. I don't know that to be the case, but I'll bet it is. So let's look at potential trading ideas. When you're trading in this choppy behavior, what we would consider the anatomy of a sideways moving stock, the obvious approach is credit spreads, condors, butterflies, things that take advantage of sideways price action. We could add calendar spreads definitely on there. Maybe diagonals, but definitely calendars. Calendars are, a sideways approach. The only issue with calendars, of course, is that you have that longer dated option. But if you keep selling shorter dated against it, it just stays in that sideways behavior. That can be a very profitable trading strategy. Because hypothetically, if I own a 1 month option and I sell a 1 week option against it, I can probably get half as much premium for this as I paid for this. So if I can get half as much and then I can sell it 4 times, until this month arrives, I can make a lot of money, right? And so that's kind of how options are priced. 4 times the amount of time might only be twice as much the amount of money. So I'm buying 4 weeks, but I'm paying only twice as much as the 1 week options. And that's pretty commonplace. So those would be strategies. Think about how you would construct these strategies in these trades. Well, it's pretty apparent that if it might be hard to pick the exact levels, but if you believe that this is going to be the behavior for a period of time, and we're going into that environment, well, then we could construct credit spreads. You could sell call spreads up here to generate income. You can sell put spreads down here to generate income. You can do both. That's what they call an iron condor. You could butterfly it, where you build a structure that kind of has a risk graph that looks like this, right? Where you have more profit in this range, and then you get into losses outside of this range, and so on. You can construct a variety of different styles of trades based on the expectation that while I don't know exactly where we're going to end up, I don't think we're going anywhere of substance and significance. So, in summary, when we look at this, consolidations are kind of a pause prior to a potential explosive move, whereas sideways trading is range bound. It's listless without conviction. One other approach, of course, could be that if you're convinced it's range bound, then you buy weakness. And this is a hard thing, but you buy weakness and you sell strength. Now, that can be very dangerous because if you get caught in a trend, this is why we have stop losses. The thing I caution against is don't buy weakness and then keep buying more weakness and more weakness and more weakness and keep doubling and tripling down. Don't do that. You'd have stop losses and so forth. But the basic concept would be, think about that Tesla chart. Think about that Intel chart. If you were a buyer down in the lower end of the spectrum and you were a seller up in the upper end of the spectrum, you can be buying and then selling. Buy low, sell high. Short it up here. Not only sell your profit, but flip your position, get short. You cover your short down here somewhere and you get long. You cover your short or you sell your long, pardon me, and you get short, you cover your short and you get long, you can be literally flip-flopping your trades in that approach. Now, again, in a range environment, you're not so much trying to pick a precise area as a level, and your stop loss would go outside of that, so that if there was too much movement, you got to give yourself a little room, but if there was too much movement beyond and it's breaking out of its sideways trading range, you're going to be stopped out at a loss. But if it stays in the range, there can be a lot of profit potential trading within that range for a period of time, buying at the lower end, shorting at the upper end, and taking profits on the opposite side of your entries. So hope that makes sense. Let's jump over now. I actually want to look at the market. I threw a challenge out there for Intel, so we'll see if I'm right. Let me pull up. We'll go to stockcharts.com, and as most are doing, it's breaking higher today. I mentioned that the ADX might be turning up a little bit lately because it's seeing a little bit of an upward thrust here. But let's go add the ADX indicator. So here's our ADX line. Let's put it above the price action. Why not? And let's take a look. So anything below 25 is kind of my gauge for whether we're in a trending environment or not. And we've pretty much been below that throughout. You can see there was a little more momentum here early on, but we've pretty much remained. I mean, that is as dead as it gets. And the price action has confirmed that. So if you were putting on trades that take advantage of sideways price action, it's been killer. It's definitely been a good environment for that. And you can see the profitability. Now, in comparison, there are definitely things that are in the same space. I mean, think about something like an NVIDIA or something like that. That's also a chip stock. That's a semiconductor. So let me click over to that. And if we look at NVIDIA, it's a semiconductor just like Intel. When you get above this level, specifically they say 30 is defined by Wells Wilder. Here you're definitely in a trending environment. So if you just look at it and you had bet on this being in a trending environment, right off the bat, it gave you a consolidation pattern. See how it's different than the sideways range. So now we're looking for consolidations in the trend. Well, that's a great bearish entry. We know the trend is down, and it's telling you it's got momentum. So we get bearish. Gives you another sideways range. We're still in the trending environment. So can you short this? Absolutely. Okay. It gave kind of a plunge here that, if I look at it, there's your huge volume. So that's kind of an exhaustion signal. Exhaustion, I talk about 4 stages of a trend. This is a prime example of an exhaustion, and the entire market had it. I pushed this point at the time. When the markets plunged down, there was a lot of high volume drops. But anyway, the ADX, if you look at it, still in its trending environment, it's been kind of a little bit slower to react. So let me mark the 30 level again. It got back below 30 here, which tells you the trend is done. And that's right in here. I think the only, one that would have probably caught you, if you had tried to play this breakdown here, that was not a good trade. It dropped for another day or two to the downside, but then it came right back above. So I could see someone getting sucked into that one, feeling like, well, the momentum says we're still in a trend. I think I would have known, hopefully, to avoid it, given the huge signs of exhaustion. When something shows, again, I ask the question, go back and watch our 4 stages, but I call this a stage 4 exhaustion. If I ask you the question, why so much volume here? If you were really, this thing has plunged from $290 per share all the way down here into the 130s. and you're finally dumping, that seems like a lot of panic selling. That it would have made sense to sell back here in the 260s or the 250s or the 200s maybe, but to sell after it's gone from 290 to 130 and after it's dropped for 4 days, $70 per share, that seems pretty illogical. And so you get that exhaustion, and then, not surprising, you kind of go into this period where now we're not in a trending environment. Now we're in a choppy environment. Now, NVIDIA actually reports earnings on Thursday, I believe, of this week, which, throws a little bit of a wrinkle. But do I think it'll kind of stay more range bound overall for a period of time and be more mindless for a period? I think that's pretty likely. So, take it for what it's worth. The ADX tells you momentum has come out of this thing and it's range bound. It's going to gap on its earnings one way or the other, but I would not be surprised to see that fade off and to see that kind of choppy behavior. Let's look at the S&P and see what's happening here in the ADX. We can use the index, or we could use SPY or anything like that, but you really had, a trending environment during this period. I'm going to highlight this area, which is about from, in here. So you could have traded this base and this breakdown, this base and this breakdown into here, and then we drop back below 30 from about this point on. So I don't think there were a lot of setups, and once again, you can see the exhaustion, just a huge volume sell-off, that exhaustion signal. It's the only volume bar, as I have the screen right here, it's the only volume bar you can see. Just a perfect sign that, the exhaustion selling hit the market. And now we're not in a trending environment according to the ADX. Now the short-term momentum is higher, right? You are kind of climbing back up. But here's how I see it, whether I'm right or wrong. The way I see it is we had a trending environment here to the downside, which was severe and probably overdone. And so you get a big bounce back, and now you're back in this range of where there's a lot of resistance, a lot of overhead supply. You're going to have some up. A week or two from now, you're going to have some down. And it's going to have a little bit of a battle. And then my projection is we fall out of here. A number of, let's call it 4 or 5, 6 weeks from now, I think you've got, and that might even be too soon. Maybe we chop around for 4 weeks and then start to fall in the next couple of months thereafter. That certainly could happen. But that's the way I see it. I think we're back in kind of that more choppy, lower momentum, not a strong trending environment. That would be my thought. All right, we'll leave it there. Hope you've enjoyed this class on the anatomy of a sideways moving stock. Have a great rest of your week. We'll see you next time. Goodbye, everyone.